Hello, everybody. Brian here from quantlabsnet.com. Today is the January 30th. I'm going to talk about the current news state and what we can do about it and how we can respond. And I'll also show you a GUI interface to all the strategy stuff that I've got with this set of clients and server working. So first off, let's check out the news here. Um, right here. So you can see the markets are down. They dipped quite deeply yesterday because of the Microsoft. I think we're on the precipice of something shaky right now. Fragile is what the AI is telling me. So let me go over there. So I've been posting more news related items here. So we're focusing on currencies, well, it's all in the futures option space. Futures options of currencies, commodities, crypto, namely Bitcoin. You'll see a Solana and along with the US market indices among whatever else can be traded at that time. So here is a new it's kind of an early stages of an Electron application. So just so you know, apps like VS Code and a lot of other big apps are written in Electron. I think even TradingView itself might be. But nonetheless, this is an interface that interfaces with my entire client server I've been talking about, with the main strategy handling all the Rhythmic data and market orders going into Rhythmic. We have here what I put out yesterday, a strategy of 5 on the euro, volatility breakout, dynamic hedge, delta hedging, volatility breakout for silver, Bitcoin, and then we also got crude oil in here. So it's running. And I'm going to run it for a couple hours and see where it goes. Also, that's important to understand when you take in all of the news items that I just showed you in that group setting here. Um, we also have the capabilities to present now something with that in a JavaScript, well, really HTML environment. I'm going to show you that now. So this is specifically for today. Okay. So here it is. So what I've done was I presented today's news or the most recent, as I said, over the last 24 hours. So this goes through a complete overview of the market in the futures and options space, divided up in crypto, derivatives, commodities, rates, FX, volatility plays, and any cross asset that you could take advantage with arbitrage and whatnot. Now, do remember, it's really important to remember, I do have my course here on at quantlabsnet.com. Just go into courses. This is primarily an advanced futures and options course with sample source code that comes with it. Currently, it's $97, and I'm gonna jack it up to 250 eventually as building all this out. But coming back to this dashboard, I guess, for today, okay, we can see here where we get market environment summary, and it's specifically for today. So we'll see here mentions of Venezuela, this Armada thing going on with Iran, with the Navy, with the US, and there's impacts on that. And it can tell you specifically what to trade and how to trade it. So here with certain instruments, namely a cross overview, and this is just for today. So I could generate this every day, every trading day. So the highest one that gives you the best um, driver is Solana futures long with CVD confirmation. And again, this is all taken out of the news that I've shown over the last few days. And again, you can see here what's driving that. Uh, the CVD turned positive, maintained bullish bias since December. We have here volume absorption at support, and then we have a gamma squeeze potential. So all of that is not what you'll get in the retail space. All of that's not going to get you from the typical social media. I call them frat boys on TikTok and whatever. And I've just discovered some really seedy stuff going on with a variety of dangerous so-called gurus. You'll lose money. All they care about is just feeding their line in their pockets. Anyways, continuing along. So we have the execution framework. Then we have another one here based upon oil, geospatial straddle for an option trade. We have here obviously the potential of a U.S. Iran military escalation. So that's built in today, the last 24 hours of news cycle. Okay, or premium return. So there's a trade opportunity there. And then we also have if there is, and as I said with the course that I mentioned, when it comes to hedging, here this gives you the specific ways to hedge and how to do it. So here in this case, when it comes to hedging, if the Armada threat proves to be bluster and tensions simmer down, oil could rapidly shed 10 to 15% of the war premium. Put leg of the straddle captures this alternative outcome. So right there, on the upside, you're covered. On the downside, you're covered with options and hedging. This is that's a big move projected based on AI. So this is just on oil alone. Okay. So this is the classic way a lot of how the wealth is built in trading with both futures contracts and options because you get so much information. But here you have these things that are driving uh, the news and eventually the futures market over the next day, 2 days, 3 days of trading sessions. So here we set up an at the money straddle on Brent crude and a put on the current strike. Now, if you don't know what that means, that's what the course is for. You accept the premium loss, which stays flat, unlikely given news flow, profit from violent move in either direction. So here's the takeaway. So no matter what happens on these type of trades in the oil market, regardless of what the news is, we can make money either direction on the upside or the downside of that move. Consider rolling if implied volatility compresses without price movements and an alternative long straddle for lower cost but requiring larger move. Okay, so this is telling you potentially what will drive it on that trading opportunity again with futures and options for specifically for oil. And then here you can see here it lists expected return 35, 35 to 80%. This is a short-term trade with a 1.65 Sharpe ratio. This is how a lot of the trading firms make their money now is you can trade multiple ways. Obviously you can trade by investing. You can also trade on short-term moves and what drives it. Here we have a win ratio potential of 68%. This is the risk reward, which is really high, 1 to 4.5, and the potential for Vega, which is a big move, is quite high. Okay, this is the sort of stuff you present to your boss if you're in a trading firm. So we have here a goal called back speed. Okay, so here we have the drivers, all-time high breakout and price discovery. We have here now. This is the thing that a lot of unfortunately retail traders don't get. We'll just call it the polite way. They're not smart money, but the smart money will see this because this is what they're seeing. Skew and kurtosis are rising simultaneously, a rare signal. Market is pricing in extreme events with a 3 sigma move. OTM puts expensive despite rising price prediction. Smart money, which is talked about, hedging long positions against violent corrections. So here's the expected return. It sounds like it's a 25% expected return with a very pretty strong Sharpe ratio of 1.55. Max drawdown, okay, negative 35%. What was the other? So here, we could have the max drawdown on the crude oil. Okay. So the goal here, that drawdown, considering it is high if you want to be aggressive in trading. I have my portfolio, my way of trading and investing. I keep multiple portfolios, but my bulk of my cash is in the conservative and trading just usual equity and stock. So here the potential, the convexity is very high, and there's GVZ sensitivity. That's the volatility on gold. It's 20% a day. So that's what's projected. So everyone's going on about the currency debasement trade. So here And again, this could be the Fed or whoever manipulating this type of trade. Um, and knowing about it enables you to profit from it. So here you have central bank buying and ETF windows signal institutional distrust of flat credibility. That's what's driving that. Okay. Um, so execution framework: one ATM call or sell one ATM call and buy two OTM calls. And we can see here the logic: it finances a trade using expensive ATM premium while maintaining unlimited upside. Again, the big benefit of options trading in the futures market: unlimited upside. Okay. If gold goes parabolic, if gold grinds up slowly or drops, the short call covers the costs. So you're kind of like neutralizing the risk here on the downside. Ideal for high IV environments where buying naked calls is prohibitively expensive. Because if you looked at my groups, um, and my own analysis of the last week, let's say, um, the buy and hold on gold alone out like easily outpaces thematic trading. And as a result, what's happening is something's going to happen to the gold over this. So take a look at Bitcoin post expiry momentum. So here we're getting a more conservative return, 20 to 35%. Sharp ratio not as high as 1.45. Max drawdown at negative 22% with a win ratio is, I think that's higher than, yeah. So it's in line with gold trade. 64%, 1.9 uh, Sortino ratio. And with the Sortino, that's including it's taking out the risk of volatility. So here, IV rank is in the lower 25 percentile. So here's a logic: options expiry, pinning release, uh, implied uh, implied volatility compression signals, consolidation, not crash. We also have here a leverage flush complete. So that's meaning all the people that are putting in projected speculated trades, we'll just call them the crypto bros, will get wiped out and always get wiped out. And believe me, all the institutional smart money take advantage of that. That's why there's a lot of institutions now getting involved in this type of trade to wipe out the not smart crypto bros, because they're being liquidated each and every time on this type of trade. So we have the corporate synthetic put. Now, this is also important to understand. The synthetic is a combination of option trades, but this is really for bigger portfolios or bigger institutions. So here we're doing known layer, or sorry, known buyer, corporate treasuries with. Now, this is impressive, and that's all based upon the news. Just in the last 24 hours, so we have 134 million allocated, act as a floor, discouraging aggressive shorting. This skews put call dynamic favorably for the long position. So the execution here says expiry to pass. So the end of January, so that's today, really, at least last trading day of January. Enter along Bitcoin future on confirmed breakout above the recent consolidation range. So we have here use risk index reset. And again, this is important to understand, is to neutralize or call it the bullish on the additional confirmation. So when you're neutralizing, again, what you're doing there is you're minimizing or maybe even eliminating your downside risk with this combined trade. And then here we got target initial move of up 15 to 20% with trailing stops, of course. Consider bull call spreads to mitigate premium costs if the IV spikes. So again, the only way to trade this out is using the automation. Knowing this and knowing how advanced I am now with the Rhythmic API for C# or .NET, I probably could whip this up pretty quick. My whole schedule is going to change over because of these kind of opportunities that's being presented. So the last one here, and you can see here the metric is on the amber risk level. Okay. Now I'm new to this. Now, again, when I rerun this process, I will get a totally different presentation, but generally the information is going to be the same. using AI that I use. So here we're buying the ITM leaps. Again, I've got that detail in my quant analytics, and I'm going to probably raise that monthly price as well because this, when I go live trading on this sort of speculation and it works, this will be very valuable. So expect it to be even higher. This is institutional level stuff again, because that's why I stress people to take this course. Okay. So here we have a delta near 1.0 mimicking futures ownership with less capital. Now, as I said, institutions with enough capital, which they do, they can manipulate the market and fooling the not smart money, the retail traders, mom and pop traders. So knowing this protects um, your potential, minimizing your downside. So long expiration avoids theta decay over the multi-month thesis horizon. Alternative bull call sessions on this to reduce large contract size, capital requirements, monitor inventory levels, and merger and acquisition news flow. So I'm showing you here, it doesn't stop. So here's the symbols you get here. So we got Bitcoin futures, we've got HG options, we've got here GC futures and options, and Brent crude WTI options. Okay. And then we have Solana if you want to take that trade. So again, it's important to always understand this, to understand these indicators: CVD divergence, IV compression, price decline, rising skew suggests that spot price weakness is a lagging indicator. Okay. Let me stress that. If you're in the spot market, you're going to get crushed. Okay. You're not trading. You're just guessing where the price goes based upon a bunch of charts and a bunch of, I don't know, past, even recent or long term past data. No offense, but this is not how the smart money does it. This is how the smart money provides the liquidity in the right moments, and it's those moves that will drive up those prices. And at the same time, when it comes on the other side, on the exit. So the flush of over leveraged positions, we know those: gold, Bitcoin, maybe open interest to healthier levels, priming markets for the next directional lag. That could happen next week. So as I said, I can run this every day, likely to the upside across multiple asset classes. So check out. So here we even have some more uh, Bitcoin crypto derivative strategies. Okay, I'm not going to go into this. Okay, but look, you can gauge out of all the overview, out of even on the crypto side, which ones look better for you. You got here one with an up sharp ratio, a Sortino, which is pretty good, really strong in fact. And here, I don't know, I don't really measure the Kalmar, but again, it explains it. Bitcoin, here's the moves again: 1.45, and so on and so forth. So you can compare each one. We have a simple Bitcoin range iron condor based upon pre-expiry. So there's three ways to trade crypto. You choose which one's right for you if this is what you want to do. Then we have commodities, right? Here we're basing upon pure news. So here we have a potential of a 35 to 80% return. Sharp ratio is pretty strong at 1.65. Risk reward is very good with a high potential on the Vega exposure. So here again, we just went through that. We have the gold call backspread. We went over that. Executions framework. Again, the copper leaps bull position. Now this is another one here, which is not talked about. So what I like about this, from what I'm seeing, is which one's going to give you the highest rate of return, which one's going to give you potentially on the win ratio. So maybe this copper leap might be one that you may not think about. But again, the time horizon on this one would be 6 to 12 months based upon what's happening in the market in terms of the economy, in terms of what happens when it comes to, let's say, with copper, with China extracting natural resources out of Australia. Where will that go? I don't know if you saw the headline news of China, or sorry, Australian government wants to take back control of the major port that China is using to extract and export all the minerals and resources coming out of Australia. So that can have an impact on this type of trade. Okay. But this right here at 70%, very good, sharp cat ratio. But one thing that this is really talked about what I'm talking about now, portfolio management, and which will give you optimal return with minimal risk but highest reward. This one we'll talk about, which nobody ever talks about online, is opportunity cost. Everyone says have your money tied in Bitcoin, have your money tied up in gold. That's fine, but then what happens is you start to miss out on other opportunities. Something like this as an example, or you put capital into this type of trade and then you lose out on the opportunity cost where you could get something where you could have a higher opportunity and a lower risk for the profit. So again, this is now going into unknown territory that you pretty well outside of ETFs can trade is in rates. Okay. So again, this is important because when you look at, actually, I'll bring it up. When you look at Yahoo Finance with everything down, typically, what the lazy money does is when you look at the volumes here, all they do really, based upon volume here, they just move their capital out of or lower their positions on equity, the U.S. market indices, into fixed income. Again, Treasury and this SOFR, what I'm about to talk about here. So this is unknown territory for here. Let's okay. So this is more conservative right here. 18% on fixed income is pretty good. Sharp ratio 1.4 is pretty good. But this is the thing, because if you went through the all of the content that I just posted into that group, namely into this right here in the groups that's behind a paywall. All of this um, comes from news, but there's you could trade these depending upon your account size. That's the thing, is that accounts matter, but that whole trend, if you read all of those from today, it's all about two things, and it's very eye opening. Number one is volatility has increased. I've talked about that. As I said, when we start to see volatility in U.S. Treasury, game is over. Like we're going to be in major panic mode. And the other one that is in the offing is liquidity, and that's what led into the great financial crisis of 2008. And this is a much bigger one because that's not factoring in national debt, which is very high. So the Federal Reserve will just basically, back then in 2008, the difference was they still had enough bullets in the gun, I guess in the bazooka, to defend themselves with minimal risk. Now, in 2026, which is what, 18 years later, we have a much higher risk here because the Fed doesn't have what it has. And the deficits are so high and the national debt is so high, all you're really doing is just expediting the eventual doom loop of the U.S., which dries up all liquidity because now you have to serve all of the um, all of the interest. One of the other interesting characteristics of what I've said in my stream, and how it's verified in the news here, is that things will it mentioned inflation 2.0. So with inflation 2.0, we are expecting higher costs right now in energy, and then the other one will be food, so agriculture. So when you start to see those moves happen, the only way to sort of circumvent that is trading futures and options, as it says here. So the volatility and lack of liquidity is going to be a big deal moving forward, and people will lose large in that, especially if you're closer to retirement or depending upon your pensions and where they're parked, which is usually in locked in investment vehicles that they can't get out when this happens. So, like people that are in a pension, government pensions, be aware. Um, Start asking your questions on where those pensions go because you will have one of two things if you're going into retirement. Either it'll be majorly cut or eliminated, haircut. So that will obviously negatively uh, go against people that are going in retirement like myself. So being aware of this helps me out. So anyways, coming back to this, we have a win ratio of 82%. So that's very, very high, but you're still getting a 12 to 18% return. So when I come back to the moves of what you see there on bar chart, it's probably because they're seeing these type of trades where you get a very high win ratio, potential 12% to 18% return, and another unhidden trading opportunity that you never see. But again, you have to have a large account to really trade in the treasuries space. So here, it's asking us to take out these SOFR futures. And this is where basically wealth is developed. I'm not going to go into the details here. So there's a no hurry. Yeah, sure. And when panic mode kicks in. But here's how you generate wealth. This is how it's all done on this trading opportunity. Basically, we're harvesting the theta decay. And that means that's income coming into your pocket from this trade as the Fed holds steady. So right there, you're able to generate income from that, from this trading opportunity. And again, that's the combination of why you want to know trade options and futures. So you close the positions before any scheduled Fed communication that might uh, shift their guide. So that's a very wise call that you pretty well not hear on the news networks. You will not hear that in media, and you definitely won't hear it from the doomsters and the frat boys on social media and YouTube. All right, so here we've got the Euro USD as well. This thing will trade it. Let's see here, right there. C 6EH6. That's the future opportunity for euro. That's a symbol. Okay, so here we've got ECB passive creates a breakout setup, structural dollar support flow. So what's this saying? Buy an ATM straddle, euro futures 6E, bet on violent move in either direction. Okay, so again, with the hedging, and again, if you take that course, you bet on violent move in either direction. So if the ECB finally responds to currency application, your current applied volatility suppression makes options relatively cheap despite the current volatility. That's really good based upon that type of trade. You increase your Sharpe ratio pretty good. Here's your expected return at 25 to 50% with a pretty strong projected win ratio along with a long plus. So this is involving, I think it's just futures and options. This is amazing what it can do. So here we're now getting involved with the Treasury curve flattener. Look at this. That is amazing. 68%, Sharpe ratio of 1.2, and an expected return of 10 to 20%. And it's hedged. That's why you got to take the course. I don't know how many times I got to say that. But there's no details on that, how to do it. Well, maybe there's, I'm just not reading it. Anyways, so we have another one for Forex. Now, everyone goes on about retail Forex, watching the charts and getting killed. Here, you can still play what we call the currencies in the futures and options market, not Forex. But here we have an Australian risk reversal. Okay. So what's happening here? The Australian dollars, okay. So you have a good return of 18 to 35%, Sharpe ratio at 1.2, win ratio of 64%, and net zero, meaning it's risk neutral. So here we anticipate the Australian dollar outpacing the G10 currencies with the central bank raising interest and then the rising Australian dollar relative to US. 4 points making Australian futures cheaper in 4 months. Now, here we have the commodity. Now, I've talked about this as well. So, this is assuming if Australia dollar serves as a proxy for Chinese growth. Depending if the government of Australia is smart, they'll allow this to trade if they care about their people and their economy. But you know how that goes. Major investments in China R&D signal emerging market sentiment improvement and supporting commodity currencies, that's including the Canadian dollar, with oil, double tailwind yield appeal, and commodity strength. So here's the framework for the execution. Risk reversal on the Australian dollar future on 6A, sell the OTM put to finance purchase of OTM call. Next, zero a small or small credit entry, profit from the Australian dollar strength, limited loss if the Australian dollar stays stable, and risk if the Australian dollar collapses. So I could probably get more details on that to protect on the downside. So these are current news events that's driving this. Another one I've talked about before is volatility. Okay, so we know about volatility. I've talked about it. So we have here volatility trade on the GVZ, which is the gold volatility zone. Okay. So here, making 30 to 80% return, Sharpe ratio 1.45. Again, these win ratios, you think that you're living in a dream. Knowing how to do this is impressive. Okay, it's right there coming out of AI. Okay, so if you went into futures and options, you will minimize your risk, but have virtually unlimited upside on these various trades. Vega exposure maximum. Ooh, I'm just going to go on about this. So we have long GVC futures on gold straddles, alternative back spread structure. Again, this is a combination of these synthetic option trades that I've mentioned. Sell one ATM, buy two. Now this is again at the money, and two out of the money to finance long volatile positions using expensive ATM premium position for acceleration either direction. Jeez. So once again, you're covered on both sides. This is what the smart money does, but they don't talk about it. Again, let me mention this too. This is how the HFT shops work. This is how the hedge funds work. Short-term trades. This is what they look for, meaning that they go out and do low risk trades, but present themselves with unlimited market opportunity. But this isn't a bad environment. I mean, this is like, as I said, when you look at what the markets right now, just raw. Well, let me show it to you. Just looking at this on these moves, and here we're projecting unlimited profit and minimizing our risk because of options and futures. Coming back to this, so here we have a Nasdaq volatile hedge. I've talked about the volatility, especially for the stock market. So this one's now just the market came out with ASML out of Netherlands. Chip giant about to hit a ceiling. That's a headline from a news item. If the semiconductor capex slows, AI-driven NQ, so that's NQ futures, the symbol for Nasdaq, faces structural headwind. So again, it's saying that there might be volatile and structural headwind concerns. VXN may be underpricing tech spec correction risk. Then we have what could be the impact of tech valuations most sensitive, uh, higher for longer rates, which is very possible. Fed's hawkish stance, creating long, ongoing headwind for growth VXN calls, provide convex hedge against correction. So again, here's the play. This is your playbook for the options market. I would not recommend this without understanding the principles of options trading. Again, from that course. OTM calls, VXN. So this is now another symbol, NASDAQ 100 volatility index or VIX futures. And remember what I said about VIX futures is gonna spike. Let's see where it's at now. So right now, let's see here. Okay, so which one's the only one moving right now? It's the VIX. So it's volatile. When everything's down, nobody's talking about it. But here, the VIX is up at 1.4. 0.42%. So again, you're using that. And here, look at this. Now I just do a refresh. It's now at over 2.1% intraday. I mean, yes, you can make money in a bad market. Was what I'm saying. So you buy OTM. Okay, where was I at? Position. Okay, so or VIX futures, right? You can buy VIX futures. Position your sizing as portfolio hedge, not a directional bet. Profit from the tech-led correction while allowing continued equity exposure. So what's going on right now, which we had all week, was the stock calls, namely Microsoft, that's dragging the whole thing down. That's why the markets are down, because of Microsoft. So here we have index versus the single stock dispersion. Okay, so Caterpillar win, Altria loses on competition, tech rate headwind. Okay, individual stock moving more than the index itself. So there is a dispersion happening. And here's what's happening that most retail traders will not see or even know what it is the index uh, implied volatility remains suppressed. So that is your future outlook call on NASDAQ. So here we have industrials outperforming on earnings, financials and tobacco lag. Rotation creates high single stock volatility. Okay, but you can take advantage of that with futures and options again within a range bound index environment. So even if if it goes flat and it's range bound, you can still make money. This is pretty incredible to know this. So here's how to do it: you sell your volatility to a SPX straddle, buy your single stock volatility. So we're getting straddle on high beta names like CAT, MO, and ASML, which we already talked about. Profit when, and again, this is very specific to today. So ASML came out in the last 24 hours. So if I known that, I could have set up this trade a day before. Profits when individual stocks move, uh, then the move more than the index. That's your alpha. Betting on the dispersion over correlation. Pretty smart. And again, you have the different types of trades. And again, you can trade around, specifically in the NASDAQ futures, because of the volatility that it brings on top of the VIX as well. It's incredible. So here we have asset trades. So what are we talking about here? So we have a hawkish Fed, growth stress signals, simultaneous rally in oil, gold, copper, classic cost push inflation signature. We've talked about that, inflation 2.0. So here we have the Russell 2000 exposed to domestic economy and logistics. This is an important one that I know, but most people don't like or don't hear about. So we always want to focus. We don't care about the current. We don't care about the past. What we care about is the future. This is the classic one on the economy. Trucking bond distresses signal goods aren't moving, meaning the economy moving into the quarter next year, long term, everything's not moving, which means you have now a contracting economy. Who cares when you hear about all of this mumbo jumbo garbage on how they're trying to redefine GDP or what a recession is, like what happened in the last 5 years? It's a joke. What we care about is data like this. Okay. Goods aren't moving. The economy is contracting, leading to recession indicator. Okay. So that's important to know, where you don't need to listen to the news. You don't need to listen to stupid politicians, because those politicians are basically brainwashing you into thinking something else when the reality is something different. So this is the RTY, which is the Russell shorts head growth disappointment. So again, here you can roll it out, not just for this quarter, but out into quarter 2 for this year. Okay, so this is a long-term trade. This is very interesting. So what are we going to do? We short 10-year notes to ZN for sticky inflation rate. Again, to do these type of trades, you have to have a larger account. These these contracts to take them out with the margin requirement are into the thousands. Okay, just so you know. Long gold future as a stagflation outperformer. Long put on the Russell 2000 for growth disappointment hedge. I can tell you right there, you're covered in both ends, the downside and the upside. With the upside of as long as gold performs, you've got quite possibly unlimited potential there. And then again, portfolio construction balances commodity long with equity short. And this is not, I mean, this is a pretty good rate, 25 to 45% return. But here you go, maximum drawdown negative 18, a decent sort sharp uh, correlation, low to negative. And to be honest, that's what you want if things get really bad. You want to be in uncorrelated trades. You don't want to be in Bitcoin that's correlated to something. You don't want to be in gold what's correlated to something. You want to be in uncorrelated trades, meaning low to negative. So if things got really bad, this could be a really good trade. That's all I'm saying. So here, 30 to 55% return, 1.4% return. You got to like these win ratios of 68%. Volatility is high. So there's some risk here. So here we're going to long gold, copper futures, long silver, use options for convexity. Okay, again, using these backspreads leaps, define risk structure only, no naked shorts in tail risk environment because you'll get killed. Okay, so here, which I can kind of confirm, but again, the media lies to you as usual, that China may rebound. Okay, so here with the latest trade with UK, with the UK agreement. So if AstraZeneca, the large British pharmaceutical, puts $15 billion into China for R&D, okay, and that's defined now. You can trade off that. That just happened yesterday. Massive multinational investment signals global companies not decoupling from China as aggressively as feared. Potential bottom in Chinese sentiment. And this is why you get President Taco crying like a big baby, whining like a baby, because he knows this is true, and yet he'll lie or whatever to prevent this type of investment from happening. And again, when it comes back to China, as I mentioned earlier with the copper trade, again, we have a pickup in industrial demand in China, R&D, manufacturing ramp up, copper demand follows, and then the Australian dollar also serves as Chinese proxy uh, as well. So again, this is what we call an emerging market sentiment. Again, you will not hear about this in the news. Okay, I guarantee you that. So here's what we're doing: a long copper future for in China industrial proxy, which looks like it could happen based upon, well, win ratio is not that high, but it's higher than most outlook that you'll get with other posed trading ideas. So here we long Australian futures, Australian dollar futures, China correlated currency. Consider, well, I think you could still get access to the HSI through other exchanges. You can definitely trade that through Rhythmic. Okay. Now, I would never have considered this because I'm supposed to only focus on the CME and CME exchanges, but the Hang Seng might be an interesting one to watch. So here we're gonna call out. I don't know where you get them, but you can definitely get them in Rhythmic. Consider an H or Hang Seng future for direct Chinese equity exposure, and use the call options for it to find risk. Unreal, and that's just like today of all of these trades. But obviously, the ones you want to focus on are the highlighted ones. But I've already gone over some of the other ones that in bad, really bad market conditions. There's some I just presented also uncorrelated and fairly low risk. So again, the next process is to take those ideas and do this. We've got the trading server already set up on the technical, that's C sharp. And we've got now all of these opportunities currently from the last 3, 4 days. And now we got a whole slew of new ones right here that we can probably develop automated strategies for, um, that we can develop in the detail and go into the quantitative if I wanted, as I've shown, well, for those that are new here. And if you had access to this, okay, to this private group, all of the available, and I can run in very detailed, high frequency trading, quantitative level type of strategies that they come from. But the drivers of what's going to drive potential profit, just like what the institutions do probably every day, especially from a not just from a trading desk with a portfolio manager who, let me remind you, gets paid in the millions. And then there's the lead portfolio manager is going to be much higher. They have all these options just for today based upon news from the last 24 hours. So as I said, here's what you do. Okay. So quantlabsnet.com. Let me just pull it up here. You first step is to subscribe right here. Okay. So just do the learn. And here, if you're on the technical front, you get access to this C++ HFT ebook. Then next option I'd really recommend is to try this out for 7-day free trial. This also will give you a snapshot introduction onto that, what will be a very expensive futures and trading course based upon what I'm seeing with way AI's rolling out, all that, what's mentioned there. On top of that, I'm probably going to get rid of this service to talk to me one-on-one. I'm just kind of like focusing on uh, more on the trading firms. But I'll leave it at that. This is a powerful insight. I'll make this presentation, and you can see it's an HTML file. So I was going to do the Python Streamlit. That's hard to distribute because most people don't know how to set it up. But everybody knows how to open an HTML file locally on their browser, and it's self-contained too, so they can go through this at their leisure. So you can imagine the kind of things that I could put out each and every day with an HTML file now. We'll leave it at that. Thank you for watching.